My name is Greg Durrett of Future Secured Financial, and I'd like to welcome you to how to plan for the 3Ds of business succession. Business succession anyway, right? Well, it's pretty much what you think. You're moving a business from one owner to another in the most efficient way possible, and you want to make sure that it is among the choices of proactive, passive, or inactive actions that you're doing something proactive to make sure it happens. Because guess what? No matter what, it is going to happen, whether you like it or not. All right, so the 3Ds of business succession. What do we mean when we're talking about that? Well, the first D, disability. It's not a guarantee, but it's something that needs to be considered, particularly when you have two partners or more and there's a buy-sell agreement in place between them to try to protect the business entity. Of course, death, again, not necessarily going to happen while in the business and active in the business, but it is certainly something that needs to be addressed. Departure, that's a guarantee. One of these days you're going to leave the business, whether it's because of one of the first two things, or you just simply decide it's time to retire or sell the company. So two of these are guaranteed, right? Death and departure can happen. Prudent business, well, if you're only protecting two out of the three legs of the stool, you really haven't balanced your stool. All right, so what are the three options? Well, you could just leave it to your estate to figure out, right? Just say, hey, whatever, it's going to work. They'll figure it out. Or you could allow for whatever, due to lack of specific planning, you don't really take any plans. You just kind of look at it and say, yeah, we'll figure it out. Or you actually do the proper thing, the smart thing, and put together a buy-sell agreement that is properly funded and structured to make everything smooth, even if you're not able to take care of it. So what are the considerations? Well, if you don't have a written agreement, what? Anything can happen, right? And it will. You'll get lawsuits from spouses and children and creditors, and all sorts of things can happen because there's nothing guiding it. When you have an agreement in place, the opposite is true. What you want happens. Right? Your heirs, well, you don't want them having to deal with somebody else or having to maybe, God forbid, do a fire sale on your portion of it because you didn't have a good plan. But good plans can protect that. And you must always remember, putting the plan together, you have to have it funded properly. Anything could happen at any time. It's like buying a car and not putting gas in. You can't go anywhere, right? So it needs to be funded properly. So what are your options? Well, you could always do loans to fund a buy-sell agreement, sure. They come in all forms and varieties. Cash, well, that's also an option. Now, you keep in mind those first two are going to hit the business and the family and your heirs very hard. Insurance, that's actually a pretty strong thing, and everybody grimaces when you say insurance. Well, let me tell you something. Only insurance it can be paid for while you're actively producing, while the business is at its best. It's bringing in revenue. It's really going strong with all partners and all cylinders running hard. That's the time that you take an expense, not when a critical event has occurred. So let's look at disability buy-sell insurance. A little bit different than regular. Now, what does it do? Well, it of course will look at whether or not permanent total disability has occurred, and that's what you want for a definition. You want to also have it be your true own occupation, so that your occupation is what is being covered, not some other occupation that you might be able to do based on your experience and history. Policy features. Well, a lot of times you can get a waiver of premium. So if you're disabled and you have a payout portion of it, well, the premiums will stop after 90 days, which is good because you don't want that added expense. And there's also the term of insurance, meaning how long do you want that policy to stay in a non-cancelable status. So that, longer, well, the more you pay. And of course, there is always this exclusion that these things are not covered unless, of course, they say they are covered. Passive war, terrorism, or forget about. All right, so let's do a sample case so you see what we're talking about. All right, we got this consulting firm. I'm not going to read you all of this. You got partner one, partner two. Partner two is a little younger, partner two is older, and neither of them have any debt that's really crippling, but they do now know that they have this unfunded business liability. All right, so they wanted to look at partial and full funding options, and that's an option too. You can always do a balance between the two. So here is how it breaks down. All right, they can do a monthly option, all right, and keep in mind term of insurance, that means it's 5 years. You're buying basically a 5-year policy. You want to produce a monthly benefit that's sufficient to take care of the buy-sell agreement obligations. And an elimination period, what that means, it's like a time deductible. So it doesn't kick in for the first 365 days, but then it will pay out for the benefit period of 2 years, equaling the total benefit amount that matches the buy-sell agreement calculations for the buyout of that other partner. Or you can do a lump sum saying, hey, look, you know what? I don't want to deal with this monthly stuff. If I'm disabled, I want out. Or if you're the other partner, you're saying, hey, listen, if you're disabled, I want you out. All right? And so, boom, here it is. It does a one-time payment, same amount, same elimination period, but it just pays it one big lump. And that's an option too. A lot of folks like the lump sum. All right, so what does it cost to do this kind of stuff? Well, it's based on age and stage, right? You know, there it is. There's the premiums for monthlies, and also if you want to do annuals. So it's really very, very reasonable when you consider the amount of benefit that's going to be produced. And of course, there is a savings if you pay it all up front. Then that's going to save you a big chunk of dough. So anyway, I'm not going to talk through this entire page, but you can see that. You can pause the presentation to look at this yourself. All right, so death funding. Here's one option, term life insurance. All right, if you do term life insurance, what are you going to do? It's very low premium, the lowest out there. You're not going to get any cash though, and you can pay it any way you want, whatever. Now, sample case again, same partners. All right, let's look at a 10-year term, 15, 20, 30, and then this GUL to 100 or 121. That GUL stands for Guaranteed Universal Life. And what that is, it's like a term insurance policy that doesn't accumulate any cash value, but you get to dial in the age to which it will roll. All right, so here you have the varying premiums for these different coverages, right? And you can run through this each and every time. Again, using those same figures for the buyout, right? All right, 900,000 and 600,000 of coverage. Here again, you can pause and take a look for yourself to see how these net premiums end up working out. So departure, let's call it retirement. Cash value life insurance. Oh, another dirty word. When you actually put it in context of how it is that it works for you. It's very tax friendly if you structure it the right way. It is hyper aggressive cash value accumulation. So that means that you have some what? You have some duality to the purpose of this. I'll get into that in a second. So it's flexible too, because what you can do is you can adjust that death benefit up and down based upon the business valuation. So if the business is doing poorly and you want to get less coverage and save some money, you can do that without having to go through underwriting another time. If you do want to add coverage, you get underwritten for the additional portion above what you already have, but you're never going to lose what you had before. So what are the advantages? Well, tax-free distributions. You can actually get money out of this thing in a tax-free way if you do it the right way. Flexible premium and death benefit. Again, we just talked about that. Takes care of 2 out of the 3 Ds, death and departure, because guess what? If you fund it properly, what you're going to be able to do is you're going to actually be able to say, okay, if I were to die, that death benefit is going to step in and pay out to my family and the business is now sold. If I decide it's time to retire and you funded it properly, now you have a built-in retirement plan that has been accumulating tax deferred all these years, and now you're going to be able to get at tax-free. Heck of a thing if you do it the right way. So there are a lot of ownership options that are going to take advantage of the current tax laws. It's the lowest overall cost. And by cost, I mean net out of pocket. Looking at how the cash value accumulates versus what you paid for it, it's going to ultimately result in the lowest out-of-pocket cost. And it also, the biggest advantage, it releases the company from all these future unfunded liabilities that are huge, huge. It's not going to go away. All right, here's the numbers. Partner 1, looking at the premium, initial death benefit. Wow, look at that. It's even higher. And you're looking at the premiums, big premiums, but you're only paying for 10 years. And you look at the cash value. Look at the death benefit, all right? Plus you're saving that term insurance that's just simply an expense that goes away. Quite impressive. Partner 2, same thing. Feel free to pause again on this particular screen to give yourself a chance to go through the numbers and understand. All right, these numbers don't lie. All right, had 1.8 million of unfunded liabilities that could come due immediately. They die. There's a cost to meeting obligations, folks. Whether you wait or not, you still have a cost. All right, so you want to produce the lowest cost solution that protects you at 100% of the risk, because that risk is there 100% from day one. So how do the numbers work? Let's say the death occurs during the funding period. Well, the death benefit is going to pay to the business, and the excess, the death benefit is going to pay to the heirs, your heirs, and the excess death benefit goes back to the business. If it occurs during the funding period, disability would pay for what? The disability. And the cash value and premium savings goes where? Back to the business. So departure occurs during the funding period. All right, well, it's going to be discounted on the cash value. So if you leave early, you retire early, you're going to get less. That's just the way it is. And what's going to happen? The business is going to save the future premiums that were being paid. So if departure occurs after the funding period now, the cash value goes to the departing partner, and the premium savings now goes right back into the business. And that's how My name is Greg Durrett, Future Secured Financial. You can reach out at the contact info below and have us come out and evaluate your company in your buy-sell agreements in your particular structure to see how you can best, most cost efficiently get a funded buy-sell agreement and eliminate all those unfunded liabilities. Thank you.